Hey everyone, this is Jeff Dorman, Chief Investment Officer at ARCA, back again for another edition of That's Our Two Satoshis Live, joined today by the one and only Sasha Fleischman. How are you, sir?
Living large living.
Good, happy to hear it. You excited for football season popping up again?
We need something because baseball is becoming unbearable. No hockey, no but basketball. This is embarrassing. Worst time in
Well,
sports right now.
I hope your Steelers do terribly this year. With that in mind, let's talk about what's going on with the digital asset markets. So, for those who are new to the show, we write a weekly blog every week. Been doing this for over 4 years now. You can find it on our blog, ar.ca/blog. We call the weekly macro piece, That's Our Two Satoshis, which actually, if I remember correctly, Sasha, you came up with that name, didn't you? That's Our Two Satoshis?
I came up with it for ARCA. I'm pretty sure I co-opted it from someone else like 4 years ago. But
Well, I'm glad you gave it to us and let us call our blog that 4+ years ago. So anyway, what we wrote about this week, and again, you guys can follow along in the blog itself, but two main topics this week I think are kind of driving market sentiment. One obviously is what happened with tornadocash and the OFAC sanctions. So we'll get into that second. But first and foremost, I made a sort of an off-the-cuff argument on Twitter that I think digital assets have already decoupled from macro, and then I went in a lot more detail in the blog. And I'll give you my rationale for why I think that, and I'd be curious your thoughts on that. So, first and foremost, I think it goes without saying, since November of last year, we've been in one giant trade caused by the macro, right? You had the inflation print starting to ratchet up, and you had the Fed and other central banks around the world basically doing everything they can to try to stop that growth in inflation with rate hikes and other ways of reducing liquidity in the market. So as a result, first half of last year was pretty highly correlated, right? Everything from bonds to real estate to fixed income to digital assets, all trading in the same way, with the exception of really being commodities, the only pocket of strength. Most people, in my opinion, that I've seen out there have pretty much assumed that this is still a macro-driven market, right? Everything I read in Twitter, everything I read from other third-party research firms, they're all just talking about the macro, the macro, the macro. I think it's over. I think the macro is no longer affecting digital assets, and here's why I think that. To start with, everybody in digital assets was thinking that we would have a decoupling, but they assumed the decoupling would be to the upside, not the downside, right? That eventually we'd stop tracking stocks and digital assets would go higher. I think the decoupling happened in May around Terra Luna. The only problem is nobody noticed it because we actually decoupled to the downside, right? So if you look at a graph of maybe the NASDAQ versus Ethereum just as a proxy, you can see pretty clearly that digital assets started to break down right around May 10th and May 13th when we had the Terra Luna UST implosion, and then decoupled even further to the downside about 3 weeks later when you started getting the rumors of Celsius and Voyager and eventually Three Arrows going bankrupt. So that was the first decoupling to the downside. And then what happened on the upside, I think everyone knows that both equities and digital assets all started to rally around the same time in end of June. Everyone assumed that was macro driven. I actually think it was two very specific idiosyncratic things that happened. They just happened to happen on the exact same date. So basically, from a macro side, you had the peak inflation narrative. Basically, you started to have commodities prices starting to go down, manufacturing data going down, housing data, everything from an economic standpoint was starting to go down. And as a result, the market started to price in or at least taking the foot off the gas from the Fed with regard to the inflation fighting. While that was a macro event and drove equities, I don't think that's what drove digital assets. What I think drove digital assets was at the exact same time, you had two very important things happen. You had the first real ETH 2.0 merge date, right? That was the first time on an ETH developer call that we had a set date that the ETH merge was going to happen right around mid-September. And you also had the bankruptcy filings of Voyager, Celsius, and Three Arrows, which basically removed an overhang. So anyway, Sasha, that was a long-winded intro, but my thoughts are that digital assets are now trading on their own and have been for 2 months, and we are not tracking stocks or macro anymore. So do you agree with this timeline, that thesis, or any of the dates that I mentioned here?
So, it's on an intraday, correlation. It's hard, right? If you have SPOOs go 2% higher in a single, trading day, you're going to see digital assets respond. If you see the inverse, you're also going to see a response. I agree with the timeline of events. I think that another thing to consider is that the digital asset space is a very high beta space inherently, and you're coming off a monstrous year last year into the Coinbase IPO. Everyone's just been hearing about Bitcoin and digital assets at large for the last 12 months. Every call, every meeting, new venture deals, everything was digital asset related or adjacent. And so it was top of mind. And when everything started falling apart, December of last year into the new year, you had Bitcoin futures, you had the Coinbase public listing, you had a few vehicles, you had the mining stocks, and I guess if you want to call Cathie Wood's ARK product, you had that as well. And you had these vehicles that if you really wanted to play a slide off in markets at large, like this was the most octane, like high octane way to achieve that view. I've always been of the opinion that this market is very, contracted in terms of timelines. Our cycles are much faster than traditional cycles. And I think it's fair to say that, we led the move down and we'll probably lead the move up if and when it happens on a, meaningful scale. So, correlation to, the S&P or to, commodities or this or that, that's something that's hard to track because some months it's there, some months it's not. But more importantly, it kind of shows where Bitcoin's market structure is now versus the rest of the space. There's a reason that Bitcoin has the dominant mind share of, macro traders. There's also a reason that it is kind of weighed down by that narrative. And if you look at some of the names down the list, you'll see some names in our space that are up, 100 to 150% off the lows. So in that sense, correlation is completely busted. I think it just depends on which asset you look at to draw that correlation from.
Well, you made a couple of statements there that I want to push back on. So the first is, saying in general, digital assets are a high beta asset. By definition, you have to have a beta to something. So when you say that, are you implying that it's a high beta to equities? Or are you saying that the digital asset space has a high beta to Bitcoin? Or what do you mean by that when you say that? Because I think that's one of those statements that a lot of people throw out there. But when you actually have to look at that data, you have to compare it to something. So what are you comparing it to when you say that?
Well, if you're a macro trader, you are trading traditionally equities or whatever your space is, and then you're comparing Bitcoin and the rest of our space to their space. Our assets are definitely high beta compared to their assets. We'll have 20% up days, 20% down days, and nobody will bat an eye. Those are limit days in their markets. So in that sense, we're significant.
Those are career-ending days in their markets.
So like our market, like we spent so much time in this market that it becomes kind of normal for us. But we'll have 4% intra-hour swings high to low, and that's just weekend madness, or that's just one trader being sloppy on execution. Our market just moves in bigger ranges normally.
Right.
In that sense, I would consider it high beta relative to what they normally trade.
Okay, yeah, that makes sense. I agree with that. I mean, I think in general the swings are obviously bigger. I think we know that. But again, beta implies a actual statistical relationship, and that's why I was pushing back on that word specifically. Because if you actually look, like for instance, we don't talk about the actual arc of funds on the show or publicly because you have to be an accredited investor to invest in our funds. But if you actually look at just one statistic, which I can point out, is that our funds have had since inception over 4 years ago have had a correlation to the S&P of only 0.21. Now that correlation is rising. If you look at a 3-month or a 6-month rolling correlation, it is rising. It went from 0.1 to 0.2 to 0.3 and is now like 0.35. So there's definitely an increased correlation to equities, but that's still pretty low by all factors. And I think that you hit it on the head when you said if you look at it on a day-to-day or week-to-week basis, it's hard because sometimes you're correlated, sometimes you're not, and that's really the definition of uncorrelated. Right? The definition of uncorrelated is that the correlation changes. So when sometimes you're heavily correlated, sometimes you're not, sometimes you're correlated to gold, sometimes you're correlated to equities. That changing relationship with digital assets to other markets is, I think, what makes this an uncorrelated asset class. And also why I think it's important that if we're right, that we really did decouple 2 months ago, it becomes a much more interesting investment opportunity set again, right? Because you start to really rally on things like the ETH 2.0 merge, or you sell off on the Terra Luna UST move, or you go higher on things like DYDX moving to its own chain, or Uniswap fee switch, or Chili's with a partnership with FC Barcelona, you name it. Like I, for one, I'm excited that we've decoupled, if I am right, and I think it's important that we're going to get back to idiosyncratic news really driving prices up and down. The other thing you said, which I'm not going to push back on, I agree with. The other thing you talked about was in the same sentence, you kind of went from digital assets generically to Bitcoin, and I think one of the things I always push back on is that too many people continue to use Bitcoin either as the market benchmark or even just as a proxy. Even Delphi Digital, I love the Delphi Digital guys, but like they have a chart in their recent macro playbook that said crypto trading like a high beta growth stock, and then the graph is just Bitcoin versus the Nasdaq. It's like, well, that's not all of crypto, right? Bitcoin is a very unique, different asset that has nothing to do with Ethereum or Web3 or DeFi or NFTs in gaming. So I think what you said was that Bitcoin has become a macro asset. Bitcoin itself remains very highly correlated to equities and to the macro for a lot of reasons, right? One, because it is in fact a currency. Two is because mostly macro investors have gotten on the Bitcoin bandwagon. But I think what's happening as a result of that is that people are miscategorizing or mislabeling the digital asset market as being highly correlated to equities when it's just not true. It just happens to be that the one asset they look at, which is Bitcoin, is very highly correlated. Because as you said, elsewhere, things have had huge moves, right? You've seen 100, 150% moves across the rest of the space that Bitcoin just hasn't participated in.
Yeah, I think it's just a matter of understanding who we're talking about, right? In our own space, which is by comparison not very large, Bitcoin is not the market, right? It is a piece of the market, but it's not the market. When you look at all the new entrants, basically the new class of 2021, most of them being institutional, like Bitcoin more or less is still the market for them. That they have yet to. You're not seeing these newcomers come in and directly buy tranches of what you consider mid caps, even some low high caps of digital assets. You're seeing them come into Bitcoin, ETH, or maybe some of these indices, and even those compositions are 80% weighted to the two names prior. So to them, it is the market. Whether or not we tell them it's not, until they come on board and figure out the rest of this space, that is not only their proxy, that is their alpha and omega. Like that's all they have, because they've heard about it, they write their little blurbs about it, but they don't really know what it is. They haven't used it, they haven't like interacted with it. So until they do that, that's all they have.
Yeah, I agree with that. I mean, I think that's the big thing is the new entrants to the market are responding to client demand. The client demand is saying we want to trade this, and as a result, they're like, okay, they must mean Bitcoin, and therefore let's have a Bitcoin product, right? The recent announcement from BlackRock introducing Bitcoin through their Aladdin product, and even Interactive Brokers, right, one of the largest retail brokerages, announcing support for Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. I don't even know how those four become on anyone's radar as a new entrant at this point. Why Litecoin and Bitcoin Cash are still considered that. They're not even in the top 25 anymore by market cap and trading volumes. But it just goes to show you how hard it is to change people's opinion of what the market is, right? To a lot of people, the digital asset market is always just going to be Bitcoin, Ethereum, Bitcoin Cash, Litecoin, etc. I see you smirking there. Are you?
Well, those are just the four assets that were, four assets were knighted back in like 2018, 2019. You had Abra, you had Cash App, you had Robinhood. When you look at the names Bitcoin, Bitcoin Cash, Litecoin, and Ethereum, those are the four names that like everyone starts with, right? You had like even Coinbase back in the day. Coinbase was Bitcoin, ETH, Litecoin, and I'm pretty sure this was like 2017. I'm pretty sure the next asset listed was like 2 or 3 random assets and then Bitcoin Cash. Those were the big four. They've always been the big four. That like you'll see all these, like Interactive Brokers. I can't remember who they are partnering with. I think it's Paxos, but I'm not sure. But like they're integrating into Paxos system. Paxos probably, if you look, they probably offer Bitcoin, Ethereum, Litecoin, Bitcoin Cash. So it's a big loop of like everyone's starting at the same little cinder block of these are the four assets we're allowed to have, and then clients will come and say, hey, what about this asset? What about this asset? And then they kind of work from there. But this is always like that genesis seed that gets it going.
Yep. Yeah, and I think there's nothing wrong with that. I think it's more just when we're starting to just because those are the four assets or those are the ones the market focuses on, I think we have to be very careful when we're talking about the data, right? The data for Bitcoin or a Bitcoin Cash versus the S&P is very different than the data for an Ethereum or for a Uniswap or for a LooksRare or something in a totally different sector. So anyway, I think we'll see. Time will tell whether or not we really have decoupled. We have a couple of big economic data releases coming in the next few weeks. We have the Jackson Hole big meeting by the FOMC at the end of next week. Then we have another CPI data print in early September, as well as the next FOMC meeting in middle of September. So we'll get some more macro updates over the next few weeks here, and we'll see if that decoupling continues or not. So let's move on to the next topic here. And really, Sasha, I'm glad you're on the show here because I think this goes beyond my knowledge set really of digital assets. But the big news last week, of course, was that tornadocash was sanctioned by the U.S. Treasury Department. Basically, deeming any holdings that are majority owned by tornadocash are now blocked and must be reported to OFAC. They added 38 Ethereum smart contract addresses to the SDN list, which is basically the blocked person list. What does this mean? What are the implications? I put a lot of links in the write-up about what other people have said about this. I think, my opinion is that this is scary, honestly, that the U.S. has, instead of historically distinguishing the bad actors from the tools, now they're going after the tools themselves, right? This would be akin to banning email just because somebody phished you over email. What do you think? I mean, there's certainly a large outcry from the market around this news.
Yeah. I want to start off by saying I'm not a lawyer, so I can't get into like the legal implications. Confidently, I can of course, spurt out whatever I think, but it is a slippery slope in terms of just this space. I think this is a bigger deal than I guess the space is letting on in terms of like I was very surprised that we didn't sell off on this news significantly. This is kind of they pick their zone. They pick like what they consider to be an easy target. It's an easy story to wind up that this is something that bad actors use. It's you can't draw a direct corollary to Silk Road, but it was like like they found something to kind of pin on the donkey, and it's just frightening, like you said, that it's instead of just saying, oh, like we're just gonna blacklist the front end and like certain parties won't be able to use it, and if we identify a bad actor, we'll go after them. They went after the developer of the actual code, which many have argued that code is free speech, so that's it's a big reach. I think this happened in the Netherlands, so this was an international kind of takedown, and two, that I think you mentioned this in the article, like 80% of the people that use tornadocash do not use it for nefarious things. You can't, like Craigslist is still something that exists. I don't even know who uses Craigslist anymore, but back 10 years ago, when you use Craigslist, most people were doing it to buy secondhand furniture or, get someone to help them move some, lumber. Now, but all the time there was people doing things that are less than, kosher on Craigslist, but you don't see the founder of Craigslist going down the same way. You don't see Amazon taking a hit for people hosting nefarious websites using their Web3 services. So it's like it's just, where do you really draw the line of like, where is this an overreach? Where is this justifiable? The ethos of this space is rather libertarian, or at least it was. And in that sense, I think this is it's a pretty big attack on like what this space is about.
Yeah, so I think everything you said, I agree with. I think I had an interesting, when I first saw it, I had a couple of competing thoughts in my head. Right, the first was that the only thing that I identified tornadocash with was nefarious activities. Right, I mean, I think everybody knows that anytime there's a DeFi hack or a protocol hack of some sort, that chances are they're going to send the assets through a tornadocash mixer. Right, so I understand from that standpoint why tornadocash, rightly or wrongly, is associated with criminal activity. I was actually surprised when I was reading a Chainalysis estimate that only about 27% of the deposits into tornadocash are actually illegitimate, and then which means that basically 75% are completely legitimate, which was actually even more shocking to me when I was like, okay, well, even if my association with tornadocash is simply from hacking and stolen assets, what are these other use cases? I mean, I read an interesting Twitter thread. Shout out to Reza Jaffrey, RezaJafery on Twitter for talking about all the different reasons that people might use Tornado Cash completely legally and for reasons of just privacy and, you know, not wanting your employer maybe to see that you bought some ridiculous NFT or something like that. So, you know, you've been in this space for a long time, Sasha. Like, what are some of the, you know, legitimate use cases of Tornado Cash, or have you heard of friends and people in the industry who have used Tornado Cash for legitimate reasons?
Yeah, you know, you can start off with, you know, Vitalik coming out and saying that he used Tornado Cash to, you know, donate to the efforts in Ukraine, being a Russian citizen. You know, like there are many reasons to use a privacy enabled, you know, basically, like, people will call it a mixer or a washer. Like, this is no different than dandelion transactions that were being pushed on Bitcoin, or CT ring signatures on Monero. I think the bigger argument is that, you know, this happens all the time when you talk about like surveillance systems, right? Like CCTV, like in your neighborhood, and the argument's like, oh, if you have nothing to hide, why do you care about privacy? And, you know, that's not really the point. You know, those that, you know, live abroad, and especially those that are a bit older, they can tell you stories of what happens when surveillance gets, you know, a little bit too heavy. And it's one of those, you either have privacy or you don't type of things. Imagine if everybody, you know, of course your bank can see into your bank history and transactions, but imagine if I can see into your bank history and transactions, or, you know, you know, this isn't the most happy-go-lucky scenario, but like, imagine if someone was trying to hide transactions from their spouse, and their spouse goes, and, you know, it's all on chain. Not only can their spouse see it, but your kid's third grade teacher can see it. And, you know, like, what this space has done is like, you put all of your transactional history on chain, so everyone can see it if they find out where to look. And historically, people are not very good at protecting that, and especially with the onset of NFTs. All of a sudden, you know, you buy an NFT in your wallet that you've run for 5 years, and you make it your profile picture on Twitter. I just go on OpenSea and I look up the collection. I find the NFT. I go to the wallet. I can see your last 5 years of transactional history, and I can see all the, you know, if I really cared, I can peg all your wallets. I can go backwards, and there's people that are, you know, use code to do this even better than I ever could. And so it's not about what you're hiding. It's about what you should inherently not have to show. And I think that's important to separate from, because, you know, I've used Tornado Cash a long time ago. It was mostly to test it out, but it doesn't mean I'm hiding anything. It's a product in this space, and I think one that proves very valuable, for a multitude of reasons. It doesn't always have to be that you're stealing money. That's just when you hear it, because any product that's good enough for bad actors to use means it's good enough for everybody else to use.
Yep. Yeah, I agree with that. And I think, look, I think in general, this is, in my opinion, like I said, a slippery slope, a scary outcome, that somebody who wrote code could be arrested just for writing code that someone else used for nefarious reasons. I think it's terrifying that, you know, you now have sanctions against a product rather than against people. You know, but at the end of the day, I also think it's good that people like you and now me are talking about this publicly and making people aware of what this actually is, so people can learn. Because you're right. I mean, you know, we take privacy for granted sometimes, but there's real reasons why, you know, you don't want 10 years of financial history all in one place for everyone to see. And if digital assets really are the future of money, and blockchain assets really are the future of asset transfer and spending and investing, there has to be a solution here, whether it's Tornado Cash or something else. So happy, you know, from that standpoint, that this is now in the limelight. Certainly, you know, a little terrifying, and want to see how this plays out. But certainly a big piece of news last week, and I don't think this will be the last that we're speaking about it. So anyway, we're long on time here. You know, I forgot to remind everyone at the beginning, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. But that's it for the show this week. Sasha, again, appreciate you joining us. You can always find Sasha on Twitter at ArcaChemist. He has a lot of great thoughts about digital assets in general, and specifically around NFTs and gaming. Appreciate everyone joining as always, and you can find our blog at ar.ca/blog, and we'll be again back here next week. Thanks again, Sasha.
Yeah, take care.